Hey guys, James here with Waterford Business Solutions. And as we kind of continue talking about basics of accounting and some little things like that we want you to understand, a big basic of accounting is going to be journal entries. And journal entries is, well, it's the basis of all accounting. Every single transaction that you're ever going to do is going to be a journal entry. However, when you are using an accounting platform like QuickBooks Online, QuickBooks Desktop, or even Xero, Sage, something like that, most of the time they're going to take care of those journal entries behind the scenes instead of you physically doing the journal entries on the outset of everything. So we wanted to kind of spend some time specifically focusing a little bit more in QuickBooks, but also the same thing will work here for Xero and most other programs, on what is or when would you use a journal entry versus when would you use other transaction types. Before we jump in, I invite you as always to go ahead and like and subscribe to our channel to get more information just like this. We try to put out videos every single Monday to give y'all information and great subjects to work on and help better your understanding of your finances, your business, and just overall be more successful any way that you can. You can also go ahead and comment and share our videos with anyone that you think could use it. Any type of interaction with our videos helps it to reach more people so that they can get help just like you. Now, when we get into working in QuickBooks, desktop or online, there's a lot of simplification that they've done to the accounting process to help simplify your overall day-to-day work in the platform. So rather than having to go through and do a journal entry like we would have had to do even 30, 40 years ago, I mean, that the whole point it's called a journal entry is back in ye old days, 1980s, before computers. Granted, I still have some clients that are using paper books, and that's why they're called books, is because you used to keep the books. It was a paper, it was a physical binder of all the transactions going in and out. And it was a piece of paper with debits and credits, which is exactly what a journal entry is. I know we're saying ye old days, that's only 30, 40 years ago. Plenty of people on here probably remember that. But we're also moving into an era of computerization. With QuickBooks, we're no longer having to keep those paper books. We're no longer having to do those manual journal entries where we're debiting and crediting everything. Instead, they give us the options to create transactions, and those transactions are doing exactly what a journal entry would do in the first place. They're going to create the debits and credits based off of the transaction type you select. So you've got income transactions in QuickBooks for sales receipts, for invoices, for payments, for everything like that. And those sales transactions are going to affect income accounts and AR accounts or bank accounts as they need to be affected. The payments will reduce your AR and increase your bank accounts or your undeposited funds as they should. And it limits what you can do by automating the accounts that are taken care of there, so it reduces the room for error. Same thing with expenses. You've got checks, you've got expenses, you've got bills, you've got vendor credits, you've got bill payments. Those again automate the journal entry process so that the correct accounts are affected. When you choose an expense, it's going to go ahead and affect an expense account and affect a bank or credit card account correctly with the journal entry by reducing that bank account or increasing the debt on the credit card account. If you're choosing a bill, it's going to affect the expense account and increase the accounts payable. A vendor credit works backwards. It reduces accounts payable and reduces the expense account, and a bill payment reduces the AP, the accounts payable, and reduces the bank account or increases the credit card account depending on how you are paying it. So it simplifies and it makes it easy so that the program itself is managing all the back-end debits and credits. We're no longer have to manually think on our own. like we used to have to, and still in Accounting 101 classes and even 102, 103, whenever you're doing the base stuff, you need to know how journal entries work. But for the normal business owner, there's no need to know that because the accounting programs themselves are going to be handling all the back-end journal entry stuff. And there's a lot of things that these can do. Like I said, most of your income, most of your sales, most of your bank deposits, most of your expenses, most of that's going to be handled, even your payroll will be handled mostly by these transaction types in your accounting platform. But these still have some limitations to them. And honestly, most of you will never really have to use this because the limitations are things that you've got an accountant for or would need an accountant for in the first place. We've got kind of a list here of different limitations or different things there that would result in these limitations. So if you went to take out a new loan, you went and you needed to get a loan and that loan wasn't going directly to your bank account. Instead of you taking a $50,000 loan out and it was going to your bank account, we ended up taking out a loan and it might be going in multiple different places. That we might want to use a journal entry for. If it's just here's a $50,000 loan, it deposits in your bank account, we can use a bank deposit. That bank deposit can be used to create the liability and to increase the bank account there. But if we're using that to go in multiple different places, like maybe you bought a new vehicle and we've got to create an asset for that vehicle, we've got to create the loan, we've got to create maybe some expenses that are going on for maybe a service plan that you bought or taxes or something like that. And maybe there's a little bit of money you use to buy that vehicle coming out of the bank account, we would use a journal entry because that's all happening in one transaction. It's all happening on one date, but we're affecting multiple accounts. When we're using these transactions in your accounting system, it really only allows you to affect 2 accounts at a time. It doesn't allow you to affect multiple different accounts. So if we were to create a bank deposit, we can't really affect this bank account and this loan and create this asset and do all of that. We need the journal entry to do that complexity. So one place that you would use a journal entry is taking out a loan. Same thing with asset acquisition, whether it be a vehicle, whether it be you're buying a new camera scope or you're taking out a loan there for buying some equipment there and creating multiple assets all at once. We might use a journal entry there too. Now, once again, if you're going to the supply house, dropping $10,000 on a sewer scope camera, and you're just swiping your credit card or getting a bill, we can use bills or we can use expense to go ahead and do that. But if you are taking out a loan and buying multiple different assets that we have to create, that's going to be when we want to use a journal entry. A lot of the times we use a journal entry, though, are going to be end-of-year tax adjustments. So recording your end-of-year depreciation. On your tax return every year, there's going to be some depreciation occurring, and that depreciation occurring is going to reduce the value of your fixed assets, your vehicles, your equipment, your tools, whatever's on your balance sheet there. It's going to reduce the value of those assets, and it's going to increase your depreciation expense on your income statement or your profit and loss. A journal entry allows us to go in and affect multiple different assets or multiple different accumulated depreciation accounts and that depreciation account all at once. I've got clients that they've got 30, 40, 50 vehicles, and so when we do a depreciation entry at the end of the year for their taxes, they've got a depreciation adjustment journal entry that's 40, 50 lines long because we're having to show depreciation for each and every one of those vehicles, each and every one of those assets. So we've got to use a journal entry to get us that detail. We also need to, at the end of the year, potentially adjust the interest on your loans. We, at the end of each year, want to take a look at, okay, what was the value of each of these loans at the end of the year? How much was left owed on them? How much do we still need to pay? Are we matching statement to statement on these accounts, or statement to books, on these accounts, or are we a little off? And even though we might have a depreciation and an amortization schedule to help us as we go throughout the year, it may not be 100% accurate. So at the end of the year, we might need to increase that loan balance or decrease that loan balance on the balance sheet by a little bit and increase or decrease your interest. Once again, a journal entry is what we would end up using there. Equity-wise, if you are a partnership or an S corporation and you're taking owner's draws out or putting money in or taking tax draws out, at the end of the year, we've got to report to the IRS that you took this money out of the company, and we don't want to keep holding it on your balance sheet and your equity accounts because it's been reported. We just want to clear it off and start from a new scratch place. So we're going to end up going ahead and using a journal entry to figure out where you are, both either in money you've put in or money you've taken out, and then clear that out to your retained earnings. There's not a transaction type in QuickBooks that allows you to do that, so we would use a journal entry to debit and credit the accounts to get them to equal 0 on January 1st so that we can start from a clean scratch base. We may also have to do some minor liability adjustments at the end of the year. Let's say that you've got employee benefits with health insurance and everything, and our health insurance is a little bit high or a little bit low over what you owed at the end of the year. Maybe we incorrectly put in kind of the breakdown of employer versus employee share or something like that, and we've got to reduce some of your employee benefit costs or increase some of your employee benefit costs by adjusting that liability. Once again, we would balance back to whatever statement we have from your benefit provider as to how much you owed them at the end of the month, end of the week, whatever it may be, how often you're doing this. We would use the journal entry there to go ahead and increase or decrease that liability to match that statement, and then offset it by increasing or decreasing the associated expense account on your profit and loss statement. That way we make sure that the liabilities on your balance sheet are matching what you actually owe to everyone. Sometimes it's really difficult. We'll set up a payroll system, and there's 6 different deductions for AFLAC coming out of there, but you're only paying one AFLAC bill. And so you're not spending the time every single week going in and breaking down every single week or every single month when you're paying that AFLAC bill. Oh, this month went to this deduction, this month went to this deduction, this month went to this deduction, so on and so forth. So at the end of the month or end of the quarter or end of the year, however often you decide to do it, we might want to use a journal entry to help break down that payment into the associated liability accounts so that we don't have a ton of positive or negative numbers on your balance sheet screwing up and making the numbers messy. Now, ultimately, is this a big deal day in, day out? Not really, but if you were to go to sell your business, or if you had to do an audit, an insurance audit, or a bond audit, or any type of audit, it could raise questions if we've got a bunch of hinky numbers, negatives, positives, etc., that aren't accurate on the books. So we'd want to take the time to make sure that that's accurate. Overall, as you can see, journal entries are really used to kind of finalize, clean up, tweak little things here and there. And they can be, honestly, really complicated. You've got to have a lot of documentation to back them up and to support them. And they're very, very easy to mess up. So I definitely encourage you, when it comes down to journal entries and everything like that, spend some time double checking, spend some time researching, and honestly, if all else fails, work with your accountant or work with your bookkeeper, who hopefully better understands journal entries and how everything is supposed to work there, to ensure it's accurate. If you've noticed that you've got a really screwy balance sheet or a bunch of negatives or positives on your balance sheet and they're not going away and you don't know how to fix it, don't hesitate to reach out to us here at Waterford Business Solutions. You can give us a call at 864-351-0852 or shoot us an email at info@waterfordbusiness.com. We'd be happy to give you some consultation time at no cost to explain what's going on with your balance sheet, what you need to fix it, and why you want it to be accurate specifically for your business. Beyond that, it was great to have y'all join me today, and I look forward to working with you next week.